let's bring in Oliver Slope. He's with Blue Line Futures. He's located in Chicago, and things seem to be fading away here, Oliver, especially in the wheat trade today. All of a sudden, we're really getting weak in the knees and taking a lot of wind out of the sails on the wheat market. Why? What's going on today?
Well, it's the same old story, just another day in the wheat complex as we're continuing to make new lows, which has been the trend over the last several months, especially over the last couple of days, new lows, new lows, new lows. Eventually, I think this market probably can start to carve out a bottom, but I think that's going to start with conviction closes, consecutive closes back above that psychologically $6 handle. I think that's what the bulls need to really spur some short covering. Until then, the funds are going to continue to pound the table and be aggressive on the short side. And looking at the fund positioning, keeping a close eye on how they're positioned in the corn and soybean market as well. They're short about 94,000 contracts of corn broken down. That's about 174,000 longs, 268,000 shorts. I wouldn't be surprised to see this corn market carve out a little bit of a low, and maybe that's what helps wheat carve out a low as well. Soybeans, on the other hand, I'm a little bit more worried about. I know that there's a pretty darn good fundamental backdrop as far as that market goes, but 1350, 1355 is significant support. That's trendline support from the May 31st lows. We tested and held that on Friday. If we break and close below there, I wouldn't be surprised to see another 30 cents lower. The 200-day moving average take us down here 1330. Again, a lot of that has to deal with seasonality. This is not the most ideal time of year for soybeans. So although there is a decent fundamental backdrop, I think it's important for producers to look at that seasonality and respect that and protect the downside risk here.
Well, it's 1368.5 right now, but if you look at next year's November, it's 1297 3/4. Now, is that providing much incentive to book anything out that far?
Yeah, I don't think it's really encouraging a whole lot right at the moment, right? There's still a lot of uncertainty between here and next year, let alone here and this year when the combines start rolling. So I don't think there's a whole lot of incentive to get the ball moving, super far in advance, but certainly it's something to keep a close eye on going forward.
Now, on December corn, here it's 481 3/4 right now. But if you look at next year, here we're at 508 1/4. Now, that's kind of the flip side of what's going on in soybeans. Here you have a premium in the corn if you go out a year. What does that mean?
Well, I think there's still some concerns going out to next year in the corn market. Something that we're going to keep a close eye on through the remainder of this year and into next spring is that subsoil moisture. We know that there's some severely drought-stricken areas, and that's going to need to be relieved, I think, between here and planting next spring. Obviously, that's a big question mark, and I think that's probably keeping a little bit of a premium at things. But we also need to see the demand side pick up. That's really just been a tremendous headwind for the markets here recently. Hopefully we can turn a corner on that and see the markets, build a base here, see the funds start to cover their short positions, look back to the long side in that corn market, because there just hasn't been a whole lot to get excited about here recently.
All right, and I wanted to check the dollar value on the U.S. dollar index right now. Let's take a look at what it's doing. It was down about 500 points. It still is. We're down 571. September futures now at 104.495. All right, Oliver, we'll come back in a moment, and we'll take a look at our livestock trade after these messages.